As with all investment decisions, the best time to invest globally is almost always evident only with hindsight. Behavioural biases invariably deter investors when the opportunities are greatest. When markets are falling rapidly, the outlook is bleak and uncertainty intense. We've had a number of these events, of course, in recent years. The global financial crisis a decade ago and the pandemic shock last year. Not only was it tough to take the plunge when everything looked so bleak, it would have taken a very brave investor to have committed large amounts of their savings at those times. In many ways, the pandemic exacerbated these biases and fears and intensified risk aversion in every respect. It inflicted a dramatic exogenous shock to humanity, to the global economy, and to capital markets. Its timing was wholly unpredictable, nor could its impact be accurately assessed. Where are we today? The extraordinary success of vaccine development and rollout, especially in the developed world, brings the light at the end of the tunnel into clear view, and with it, economic recovery. The pace and scale of that recovery will be like no other. There's a boom on the way. Pent-up demand, a potentially huge scale of that, will be released, turbocharged by Biden's massive fiscal spending in the US and, of course, continuing ultra-loose monetary policy of all the major central banks around the world. The slide here shows the size of central bank support and fiscal stimulus for major economies as a percentage of GDP through several crises. Fiscal stimulus is on the vertical axis, central bank liquidity injections on the horizontal one. And you can see that the numbers during the pandemic are not only massive, but they're on an altogether different scale to the financial crisis and have only been matched historically during war times. However, markets have risen sharply from the pandemic lows of last March, and there are concerns that valuations are too high, that the recovery ahead is priced in. On top of that, inflation is on the rise. And as the pandemic comes under control, it's becoming the biggest risk factor in markets. The base effects of a period of negative inflation last year are falling away, and this alone is resulting in higher inflation. But other forces are at work. Release of pent-up demand meeting supply constraints equals shortages and price rises. And in recent weeks, this has become the most commonly reported concern of businesses around the world. And liquidity, of course, is abundant. Money supply in the US is expanding by over 25%, the fastest in decades, and it could trigger a period of sustained price inflation. If the rise we're seeing in inflation proves to be persistent rather than transitory, it would have big implications for monetary policy. It could herald an early end to the Fed's ultra-loose policy stance and trigger a taper tantrum with a rise in bond yields and fall in risk assets. As ever, there's plenty to worry about. But the outcome is by no means certain, and perspective is required. Aggregate valuations in some markets, notably the US, are high by historic comparisons, but they've been driven largely by the extraordinary performance of the pandemic winners in e-commerce, online and digital transformation and disruption, while those companies most exposed to the sudden collapse of activity have been struggling. The recovery now in prospect is expected to produce 40% growth in earnings in the US this year. Stripping out the highly rated stocks in the pandemic winners category and taking into account the huge recovery in earnings in other sectors leaves the rating of large parts of the market on much more reasonable levels. The same applies to markets outside the US. Many of these are more geared into global recovery than the US and trade on lower valuations, suggesting that they could outperform during the recovery phase, which is likely to be sustained for some time. The chart uses average earnings over time to smooth out the cyclical effects of the economy, and it illustrates the point. Valuations are within the range of the past 20 years and seem reasonable as we head into this huge economic recovery. The US market is the most highly rated, as you can see, but it has the highest proportion of pandemic winners. The so-called FANGs and related stocks now account for almost a quarter of the US market capitalization. The key message is that diversification within global portfolios is vital, blending assets which will provide protection in the event of a more sustained rise in inflation, including equities, which will benefit most from the cyclical recovery ahead, those with pricing power, infrastructure, property, gold and other real assets, and inflation-protected bonds where the income and principal are tied to inflation. Blend those with assets which are more defensive and would perform well if the pickup in inflation proves to be transitory, including things like the more resilient parts of equity markets, such as quality equities, those companies with consistent revenues, conventional government bonds, and other income-producing assets. But arguably, the key diversification from a client's overall investment perspective is to invest beyond their home market and embrace the wider international opportunity set. This demonstrably decreases risks and increases return potential over the long term. Global investing by institutional investors has become conventional wisdom in the past 2 decades, with a steadily increasing proportion of assets invested outside the home market. Close to 60% of pension fund assets in OECD countries are now invested in foreign markets. Home country bias has become a thing of the past, and it's usually the case that the smaller the home country, the larger is the foreign allocation. And this makes sense. Small countries have commensurately small investment opportunities, often limited liquidity, and narrow markets with inadequate diversification. South Africa is a case in point. The economy represents 0.4% of global GDP, and as you can see on the slide, the stock market is a similar proportion of broad global equity market indices, such as the MSCI All-Country All-Cap Index, a benchmark which captures close to 15,000 publicly listed companies globally and 99% of the global equity opportunity set. Put another way, a South African-based investor who restricts investment solely to domestic stocks is leaving behind 99.6% of equity opportunities. Even these stock statistics understate the risk of investing purely domestically. The SA market is one of the most concentrated in the world. Almost 30% of the market capitalization is represented by just 2 stocks, 50% by 5. Add to that the diversification benefits of investing in economies growing substantially more quickly than South Africa, in currencies which offer the prospect of long-term strength against the rand, in industries which are largely unavailable domestically, and in the world's established and emerging growth stocks. And the case for global diversification becomes compelling. Many of you will probably be familiar with the next slide, which shows the performance of a range of asset classes over the past decade. I'm not going to tell you how much you could have made by investing in the best performing asset each year compared with the worst, because that is neither a practical investment strategy nor likely ever to be successful. But it does neatly illustrate the opportunities available outside South Africa, as well as the huge variation of returns and the challenges of selection and timing. Making the investment case for investing offshore is one thing. Making the investment is another, and a rather more daunting task. Which asset classes should I choose? Which currencies, regions, countries, industries, stocks should I invest in? Growth or value stocks, large cap or small, emerging markets or developed? How much risk should I take? How do I manage volatility? And do I pick individual stocks or managers? How do I research and make these complex choices? And once I've made them, how can I access the options and implement my decisions? Daunting indeed, time-consuming, risky, and a diversion from your day job of financial advice. There is today a solution which removes the headaches, takes the guesswork out of investing, and the administrative burden off your shoulders, while providing access to the full range of opportunities globally. And that solution is to partner with a specialist offshore manager to guide you all the way along this complex journey and free up your time to focus on the advice needs of your clients. For more than 20 years, Momentum Global Investment Management has built its business with that goal and focus, partnering with financial advisors and wealth managers in South Africa and around the world in structuring and managing globally diversified solutions to help you and your clients navigate through these challenges.
Momentum Global Investment Management was established in the UK as a specialist global investment manager. The firm is part of Momentum Metropolitan Holdings Limited, a large South African insurance and investment business listed on the Johannesburg Stock Exchange. We are deliberately different. We have developed a unique investment philosophy that prioritizes the prospect of you achieving your own unique investment goals. This is supported by a tried and tested focused investment process. Together, we call this the Momentum Outcome-Based Investing Approach. We focus on designing, building, and managing outcome-based investment solutions and on providing investment consulting services.
We started Momentum Global Investment Management as far back as 1998. And the interesting thing is it was started a year after South Africa relaxed exchange controls. And Momentum responded really quickly. In fact, in a year's time, we launched this business in order to respond and to deliver solutions for South Africans' offshore investment requirements. Today, we manage well in excess of $5 billion in global international solutions. In fact, in the last 5 years, we've also started to deliver investment consulting solutions to defined benefit schemes in the United Kingdom. And today, we advise on 40 billion sterling of assets. We focus this business very much on delivering solutions to a larger expat community. In fact, we have clients across 6 continents in our solutions.
We operate in regions like Asia, Hong Kong, Singapore, Shanghai, Beijing, Tokyo, parts of Southeast Asia, Middle East, Latin America, Europe, offering services to IFAs who in turn work with expats. And we have become the go-to place for multi-asset risk profile solutions for those advisors.
When we look at employing and attracting staff into this business, the question is, of course, one of culture, right? What is your integrity? What is your can-do attitude?
We want different views. We want people at ease in being able to challenge all of us. If you've got that terrific vibe where everybody's used to working together, enjoys working together, it's an open culture where people can speak their minds without being sort of trodden on by senior people. That's very, very important. So I think that openness is very important to encourage that debate and challenging of ideas.
Momentum Global Investment Management has the best of both worlds. In South Africa, the team have behind them a very large and very supportive parent company in the form of Momentum Metropolitan Holdings. Yet they are structured like a boutique in the City of London, focused on delivering investment outcomes for our clients.
For more information about Momentum Global Investment Management, please contact Natalie Harrison at natalie.harrison@momentum.co.za. Visit our website at momentum.co.uk or speak to your Momentum consultant.
From our beginnings 22 years ago, we have combined the benefits of being in the heart of London with global reach. Our investment horizons and our client base are truly global, giving us a unique insight into international trends and developments. With over $6 billion in assets today, we're a substantial business with the additional security of being backed and wholly owned by Momentum Metropolitan in South Africa, blending the strength of a powerful parent with the nimbleness, agility and flexibility of a boutique. From our origins, we've focused on building and managing multi-asset risk profiled and tailored solutions for financial advisors across the world, as well as specialist single asset class solutions that provide core building blocks for both intermediary and institutional clients. Our solutions are designed to meet the varying goals of investors. They're based around the philosophy of delivering the desired outcome with the least possible risk, while minimizing the probability of shortfalls against those objectives, providing higher confidence in achieving goals, smoothing the journey, and keeping clients invested. How do we achieve this? Having defined the client needs, balancing capital growth requirements with downside protection, and the risks relative to the desired outcome, we use a very broad range of levers to increase the probability of achieving targets, building an optimized strategic asset allocation using that extended opportunity set, tactical asset allocation with a key focus on risk, specific strategy and style selections, and then picking best-of-breed managers from around the world. We blend the broad diversification that underpins our philosophy with the best specialist managers to implement each asset class selection. Our approach goes way beyond the traditional equity bond portfolio with much broader diversification, and it's never been more important to diversify broadly. After a near 40-year bull market in government bonds, and with yields close to all-time lows, the return potential and diversification benefits of holding safe haven bonds are substantially reduced and cannot come close to those of the past 4 decades. Starting yields are just simply too low. In recent years, we've seen huge divergence in performance of equity markets, and within equity markets of sectors and styles. A traditional approach is no longer adequate. Portfolios have to be constructed differently. Our approach recognizes this. It's tried and tested, consistent, research-driven, valuation-based, independent, developed and implemented internally. The result is true international diversification and unrivaled flexibility to seek returns whilst understanding and minimizing risk with multi-layered diversification within our portfolios. Diversification is the only free lunch in our business. We look beyond the traditional asset classes, equity, government bonds and cash, to a broad range encompassing property, infrastructure, alternatives, credit, convertibles, real assets and precious metals, optimizing the blend to include non-correlated assets so that our portfolios participate in the upside while providing protection during weak markets. An important part of that diversification and a key competitive differentiator is the use of a range of different factors or styles. In fixed income, alongside safe haven government bonds, we use inflation-linked bonds, credit and high-yield corporate bonds, emerging market debt, convertibles, floating rate instruments, as well as yield curve and duration management strategies. In equities, we follow a blended approach across value, growth, momentum, quality and size. Each of these investment styles or factors generates excess returns over time, but they do so during different market circumstances. The challenge for investors who focus on a single style is that timing the periods of out and underperformance is extremely tough on a consistent basis. And turning points can be vicious, as we've seen recently with the switch of performance from growth stocks to value stocks as the reopening reflation trade has taken hold. Our research has shown that blending these complementary styles is the best way to generate excess returns over time whilst also minimizing risk and smoothing the journey. You can see from the slide how different styles have performed. Here we're showing value, momentum and quality, and the variability of those returns through the cycle, as well as the volatility of each of them. Blending them together as we do takes out much of that volatility, yet produces market-beating returns, as you can see from the red line, taking away the selection and timing difficulties while delivering consistent performance. Having made our asset class and style selections, we strongly believe that there is no single investment manager that can consistently outperform across all areas. Highly specialized managers implementing a consistent and focused approach will over time outperform the generalist. And where our research and experience show that active management doesn't pay off, we use passive products to deliver the desired asset class return at the lowest possible fee. Our global research reach gives us access to managers across the world, an unrivaled depth of talent and an independence in decision taking that is fundamental to our process. Also embedded in our DNA is an unswerving dedication to client service and engagement. Our clients are key in all we do, and we keep it personal. Our 21-man investment team and support staff engage regularly with advisors to deliver an outstanding and wide-ranging service, helping us to develop strong and enduring partnerships with our clients around the world. Our philosophy, process and intellectual capital are embedded and reflected in the investment solutions we offer in South Africa. A range of multi-asset and single asset class funds, each with a clearly defined return target and appropriately risk profiled. The multi-asset solutions offer the full range of asset classes, investment strategies, currencies, styles and underlying managers to provide consistent and robust returns within a carefully defined level of expected volatility. From the global cautious through to global managed and global growth funds, a wide range of risk profiles is offered, all within FSCA approved structures and available offshore in dollars or onshore in rand via feeder funds. Capping out the range are our two UCITS structured global equity funds with FSCA approval expected imminently. These provide access to predominantly developed market equities in a style blended approach. Both are actively managed and directly invested with particularly low cost structures, and they're designed as core equity holdings. The Global Equity Fund combines best-in-class specialist managers with artificial intelligence in the form of systematic strategies, while the Global Equity Enhanced Index Fund uses a purely systematic multi-factor approach implemented by Robeco, a world-class quantitative specialist. This fund is also structured to avoid exposure to businesses operating in contentious areas like tobacco, coal, palm oil, nuclear power, global compact breaches, and controversial weapons. Through consistent application of our outcomes-based investment process, all these funds have excellent track records of generating attractive peer relative returns on a risk-adjusted basis, as you can see from the scatter graph, which shows the return and volatility of the range of funds since their inception, plotted against Morningstar's global peers. In addition to generating attractive absolute returns, our funds rank well against peers. The chart here shows the performance ranking since inception at over 5 years of the 5 solutions against South African peers in the top 2 lines and global peers in the bottom 2. The funds have ranked consistently in the upper quartiles, and in the case of 2 of the funds, as the number 1 fund against South African peers and Morningstar peers since inception and over most time periods. Providing international solutions and investment management is the cornerstone of our offering, but importantly, it's packaged with a world-class international platform and funds administration business based in Guernsey, Momentum Wealth International, as well as direct support for your business with an on-the-ground team of international specialists in South Africa. A partnership with you as an advisor means much more than just trying to position our funds or capabilities. While proven investment experience and expertise are non-negotiable, it's the ability to work closely with you and understand your needs that enables us to deliver an appropriate and differentiated solution. It's a key competitive edge that we offer, and it stems from our laser-sharp focus on working with financial advisors. With us, it's personal. Our clients have direct access to our team in the UK, as well as specialist distribution support throughout South Africa, whose sole job is to help you navigating the complex world of offshore investing. That support on the ground extends to platform specialists who focus on the Momentum Wealth International platform, as well as a global fund specialist who's an integral part of the UK team, but based in South Africa. Our platform specialists are licensed to provide advice, not in any way as a potential competitor, but so that they are properly trained, experienced and regulated to enable them to help you navigate the complexities that arise with offshore platforms and all related matters, drawing of course on the wider resources of the Momentum Group where necessary. Our fund specialist in South Africa is a direct link into the UK team and can provide economic and market insights, updates, support on the funds and solutions we offer, and ensure that you're equipped to handle the inevitable questions that come from your clients. Our philosophy is simple. If you entrust your clients' money to us, then you're entitled to and will receive all the information you need on a timely basis to support you and your clients. Technology is an integral part of our offering. To keep you and your clients abreast of what's going on in global markets, I'd invite you to sign up to our WhatsApp bot to have bite-sized market updates, videos, thought leadership pieces sent directly to your phone. And visit our Global Matters website for easy-to-consume information on all things related to offshore investing. In short, an investment partner that will assist in all your global matters, a true extension of your business. One trend that has been a feature of our industry in the past decade or more, driven on by the financial crisis and the rise of passive investing, is pressure on fees. We have responded by ensuring that our fund proposition remains competitive and offers excellent value for money. At an asset management fee of between 0.3 and 0.5%, we provide access to high quality, best of breed international asset managers, many of which are not otherwise available in South Africa. The two global equity funds are particularly cost effective because of the low cost managed accounts structure that we use with our underlying equity managers. And when accessing the funds via our Momentum Wealth International platform, they come with an additional platform fee discount, reducing the aggregate costs further. Momentum Wealth International hosts our dollar-denominated funds with our local Momentum Wealth platform offering access to our rand-denominated feeder funds as well as our dollar funds, a unique attribute for a local platform. But we understand the importance of having wider access to our funds, and we've got partnerships with a range of third-party platforms. Currently, our rand-denominated feeder funds are available through various external platforms, and offshore we're engaging with international platforms including Old Mutual International and Glacier International to extend availability. Watch this space for the growing number of platforms that will soon be housing our solutions. We believe that we have the expertise, experience, range of specially designed global investment solutions, the structures and platform availability to make a compelling case to choose Momentum as your global investment partner, backed up with unparalleled personal support to help you and your clients along their international investment journey. Timing the entry point for investing is always fraught with difficulty, and very few investors can demonstrate consistent success in doing so. Ken Fisher's famous line, "Time in the market almost always beats timing the market," is never more relevant than when considering offshore investing. In the long term, international equities will deliver real growth in inflation-adjusted terms, and by diversifying across a wide range of economies, currencies, markets, industries, and companies, will offer investors a much smoother, more reliable, and more rewarding journey than investing solely in a narrow domestic market. Investing globally should be for the long term. Whatever your starting point, careful selection, diversification, and patience will be handsomely rewarded. And it'll ensure that your goals are met. The best time to invest globally might have been 20 years ago, but the second best time is definitely today.